In this video, I'll discuss Q1 FY26 result and Concall of V2 Retail. So V2 Retail is a value fashion retailer. If we look at their ASP, average selling price, that is around 300 rupees, which is pretty low in terms of the other competitor like Zudio. They are at around 500 level. Okay, so that is their ASP. In terms of the geography, they are mainly present in the tier 2, tier 3 cities of Bihar, UP, Odisha. So that is their geography, but they have a good expansion plan in the uh, geographical level. I'll discuss this later. In terms of the store, they have around 216 stores at the end of the Q1 FY26. So let's talk about their result. In terms of their sales, in this quarter they grew their sales by 52%. It is a very good growth, because if we look at the situation, like Eid 2025 was in March month, and whereas the Eid 2024 was in the month of April. So if we look at the Q1 FY25, they had Eid there. Okay, whereas in Q1 FY2025 that is missing. So on a high base, they grew 50% in this quarter. So that is a really good growth in terms of the sales. Okay, so in terms of the volume, they grew their volume by 50% year on year. In terms of the ASP, they grew ASP by around 15%. Okay, in this quarter. And their guidance, if we look at their guidance also, they are guiding us for a 50% sales growth for next 5-10 years. So that is a really long term if we look at the guidance. But again, they grew by 50% despite not having the Eid in this quarter. That is really great. Okay, so that is the point. In terms of the SSSG, in this quarter the SSG was low, that was at 5%, obviously because of the absence of Eid. Okay, but at a normalized level also, if we look at the normalized SSG, that was a bit low, because in the last year's Q1, SSSG was at the level of 39%. I think it was at 39% in the last year's Q1, whereas the normalized SSSG in this quarter was at 10%. My expectation was like it will gradually reach the level of 10%, but they were guiding for a long time that they are guiding for a 80-20% of SSSG for long time. My expectation was that it will come down to the level of 10% gradual. Okay, but yeah, that is why the dip was little bit sharp in terms of the SSSG, but in line with the guidance, and they are also guiding us for a 8-10% SSSG for next 3 to 4 years. So in terms of SSSG there is no problem. In terms of the guidance, we have to see where it goes in the next few quarters. They are saying that another one point is, they are saying that in the May and June, in the month of May and June, the SSG was higher double digit, like 15-16% kind of we can expect. Okay, so that is the point in terms of SSG. In terms of sales per square feet, in this quarter they registered a sales per square feet of 960 rupees, which was 10% lower than the last year's sales per square feet. Why there was a dip? One is there was Eid in the last year's Q1, but in this quarter there was no Eid. Eid is shifted to Q4. That is why there was a little dip. And another one reason is that the opening of the new stores, because if we look at the old stores, they are performing at 1100 rupees, whereas the new stores are at around 800 rupees. because the management is saying that the new stores are performing 26% lesser than the old stores. So because in the last 2 quarters they opened around over 50 stores in the last 2 quarters. That is why the sales per square feet was little lower in this quarter. But their long-term vision is to take this sales per square feet to a level of 1200 rupees. Okay, so in terms of the sales per square feet also, that is relatively good. The result is good, I think, and the guidance are also really good, that they are seeing a 20% kind of a jump in terms of sales per square feet in the next 2-3 years. So that is the point with sales per square feet. And if we talk about the newer geography, they are going newer states, and they are saying that in the new states also we are seeing same kind of a trend in terms of the sales per square feet with the older geographies. So that is also a good thing, that the newer geographies are also performing as well as the older geographies. So that is the point. And in terms of the store expansion, in this quarter they opened around 28 stores in Q1 FY26. Till now in Q2 FY26 they opened 9 stores. In terms of the store expansion, they are guiding us for 100 to 120 stores for this year, whereas in the last Concall they gave a guidance of 100 stores for FY26. So they increased their guidance in terms of the store expansion, and in the year of FY27 also they are guiding us for 130 stores in the next year, in the next FY. Okay, so in terms of the guidance also they are giving a very very huge guidance. In terms of, if we look at their FY27, they are saying that if the performance of our company remains in this level, like 50% sales growth, SSSG at around 10 to 15%, margins are, if the margins sustain, then they will open around 130 stores. If there is a dip in the result in the coming quarters, then they will relook at their store expansion number. Okay, so that is the point. Because if we look at their limit, if we look at their benchmark, they are targeting that 30% lesser performance from the new stores than the older stores. So that is the benchmark they are targeting. That, like as I said, that if the older store is performing at 1100 sales per square feet, then the new stores have to perform around 750 kind of a level. Then only they will expand at a high pace. If they fail to do that, then they will rethink about the expansion. So that is the point they are saying about, that they are not expanding blindly, but they will expand strategically. Okay, so that is the point. And also one other thing they said, that in next 6-7 months they will be expanding in 25 states. So till now I think they are present in 9 or 10 states. So there will be a huge expansion in terms of the state also. And another thing is that they want to be a national level retailer in the next 3, 4, 5 years. So that is another thing. And in the next 1 to 2 years they will open 75% stores in the older geography and 25% store in the newer geography. So if they open around 100 store in next 1 year, 75 will be in the older geography like UP, Bihar, Odisha, West Bengal, Chhattisgarh, that is the geography they will open 75, and then newer geography like Maharashtra, Punjab, that those are newer geography, and in those new geography they will open around 25 stores out of 100. So that is the thing they are saying, okay. And in terms of the competition in real estate also, they are saying that they are not facing too much competition, because in tier 2, tier 3 cities they are getting real estate at a good price, at a good place also. So in terms of the competition, they are not facing very very bad competition, like I mean, that is really in control within them. So that is the point with the competition also. In terms of the margins, in this quarter gross margin was at 29%, 29.5%. They improved their gross margin by 50 bps, and they are saying that they will hold this level of 28 to 29% for next few years. In terms of the EBITDA margin, pre-index level, they reported a EBITDA margin of 8.3%. So in the FY25, the whole year they reported a EBITDA margin of 8% pre-index level, okay. And they are saying that there is a scope of improvement in the EBITDA margin, because if we look at their warehouse, if we look at their head office, okay, then the cost of warehouse, the cost of head office will be distributed over a large number of stores they will open. So that is one thing. And the second thing is that if they can move their sales per square feet number to a higher level, like as I said, they are targeting a 1200 rupees of sales per square feet, then also their EBITDA margin will be better, okay, in the future. So they are targeting a EBITDA margin of 10% in next 2-3 years, but they are saying that anything over 8 is good enough. And if we look at the SSSG and EBITDA margin, the SSSG and EBITDA margin comparison, that they are saying that if the SSSG is at 13 to 15%, then the EBITDA margin can reach around 10%. If SSSG number is 8 to 10%, okay, then they can reach 9% EBITDA margin at a pre-index level. So that is the thing they are targeting. Mainly they are targeting 10% of EBITDA margin in next 2-3 years. So they need around 13 to 15% of SSSG. Okay, so that is the point. But also they are saying anything above 8% is good enough for them. So that is the thing with EBITDA margin. Okay, in terms of the PAT, the management is saying that they will be PAT positive in the whole year. Every quarter they will be PAT positive for FY26. If we look at their past, FY25 they were PAT negative. In the Q2 FY25 they were PAT negative, but in this year they are saying that they will be PAT positive in all 4 quarters. So that is also a really good thing. In terms of the, if we look at their Q1 FY26, they grew their PAT by 62% at a pre-index level. So the growth was really good. They had their operating leverage also in this quarter. So that is the thing with the PAT. Okay, and if I talk about the fundraising, they are planning to raise a fund of QIP of around 400 crore in next 1 year. They have not finalized yet that when they will do, but maybe in this year they will do. But the thing is that they are doing this to grow at a higher pace. It was not necessary for them, but they are doing this to strengthen their company. So that is the thing the management is saying, because what they will do with that 400 crore, one is they will pay their vendor much faster. Like now they have I think their payable day are around 70 days. If they can improve that number to like 50-60 day, so they can extract some extra margin from the vendor. So that is one point. The next point is the debt repayment. They have around 120 crore of debt. So they will repay the debt. And another thing is that they are going to open new stores. That they were planning to open 100 stores in FY26, whereas now they have a plan of 120 stores, and in the next year they will open another 130 stores. So if we look at the next 2 years, they are planning additional 50 stores. Okay, so that is another point of raising the fund. So that is the point with the fundraising. So yeah, if they can grow at a high pace, then it is completely okay to raise a fund for that. So that is the point. In terms of the demand situation in the geographies they are in, they are saying that yeah, there is some kind of a demand problem in the tier 2, tier 3 cities. But the thing is that with B2 retail, they are not facing the same. They said that in July 2025, the performance of the company was really good, above expectation of the management. So that is the demand situation. And another thing is that now if we look at the demand, it is little bit low if we look at other retailers, but the management is saying that if the macros improve in the future, then they can grow at a higher level. Okay, now they are growing at a higher level, so the level can be much higher in the coming years. So that is the thing the management is saying. So the if we look at the whole Concall and the whole result, all was really good. In terms of they increased their guidance about the store expansion. They are holding their guidance of revenue guidance. In terms of the PAT also, they are saying that all the fourth quarter will be PAT positive. In terms of the margin expansion, they are saying that they will improve. And another thing is that their ROE is at 27.5%, which is really good kind of ROE. So that is another point. And they are improving their ROE for a long time. In FY24, their ROE was at 10%. In FY25, their ROE was at 25%, whereas in Q1 their ROE is at 27.5%. So ROE is another point. So in terms of the whole company is going in a right direction. If we look at all the metrics that we have to look at, if it is a retail company, all the metrics in terms of revenue, in terms of margins, SSG, in terms of sales per square feet, all the things are going in a right direction. So that is the point with B2 retail. And the Concall was really good. The guidance was really good. The management is pretty confident about their performance, and if they face any kind of issue, they said that they will rethink about their growth. So that is the point with B2 retail. So that's it for the video. One other thing I have to say, that if I look at their valuation, they are trading at 80x PE, whereas if we look at Bajaj Style Retail Trend, they are trading at over 100x with much lesser revenue growth. So in terms of the valuations also, I think B2 retail is far better placed in terms of the valuation. because they are growing at a much higher pace than the peer, and they are trading at a much lower PE than their peer. So that is the point I have to say. So I do not think there is nothing much left to say with this. So that's it for the video. Thanks for watching.